The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's make some money. Before we get started, I'd like to thank everyone for getting me the required amount of minutes per view. Thank you. But I also need your help to get me to 1,000 subscribers. So please subscribe and share the video. And when you do subscribe, make sure you click that alert because the nature of this kind of information, you need to get it as soon as possible in case you want to make a decision, take an action, um, or talk to your financial advisor based on something I said. In either case, whatever you do with the information, you need it quickly. You need to know. Okay, that's that. What we have here is the TVIX. It's today we're going to mostly be talking more about these bear funds. They're risky. They're high reward, high risk. Now, my opinion, that's just the fact, that part. My opinion is at these levels, at this price level, the risk is low. We're already, I believe we're at the bottom in a lot of these bear funds. And if you put in just a small amount, an amount that you feel comfortable losing, okay, you're not going to cry over it. This is not something you would put in, use your retirement money for. This is something, money that you would spend on a pair of Jordans or some entertainment like going to Vegas or something. Money that you would just throw away doing something frivolous any other time. That it's that amount of money that you should look at. If you're going to invest in this, that's the amount of money we're talking about. So whether that's $100 for you or 1,000 or 1,500, you know your spending habits and where you are, in the in the flossing game. You know where you are. Okay, look at your shoes and look at your watch. Look at your entertainment budget. So you know. All right. I am doing this video again because someone, I don't want to call the person's name out, but someone actually made a little money in this, and I did not ask them for permission to use their name. That's why I don't really want to use their name. But they made a little money in this, and they read the information about these funds. All of these funds have prospectus, and those are like the notes from the broker telling you what the objective of the fund is and any other key information. With this fund, they tell you on one hand that it's the inverse of the S&P. It's 2 times the S&P 500. So that means as the S&P 500 goes down, this fund is designed to go up. But they also tell you that it's it may not track the fund accurately, and B, they say that you're not supposed to hold it for long periods of time. Now they have to say that because that's not to say that some people don't hold it for long periods of time and make money. There were people who shorted this fund, years. So somebody could have shorted this in February of 2016. I'm looking at monthly chart, and they would not have lost money, and they could have held it for 2 years. Now in the prospectus it says that you're not supposed to hold it a long time. Now they have to tell you that just in case you try to hold it a long time, and then the fund becomes aberrant because of some tricky stuff they're doing in the way that they're investing with it. So they have to say that in the prospectus to cover themselves. Now, I appreciate them telling me that. I've made money in these types of funds, and I've lost money in these types of funds. So what they're saying is true, in that these funds don't always do exactly what they should. And so, but do I still invest in them? Yes. Why? Because the profit potential is too great. What do I do differently after having taken a beating in some of these funds? I don't assume that they move like they say they're going to move. So if I see, in this case, this is the S&P 500. I don't look. Say if the S&P 500 is going down, I don't assume that this is going up just because the S&P 500 is going down. I actually bring up the chart and look at it. Okay, and I draw my trend lines. I'm doing my stochastic reports. I'm using. I'm looking for engulfing candlesticks. I'm treating it like it's a standalone symbol. I'm not assuming that this correlation is going to hold up, because I've had it fail. Now, I don't at present own any shares in this, but I'm seriously considering it. I'm in a different bear market ETF that's based on gold, and it has not started really moving at a fast rate yet, but I believe it will. But I still think that these funds here will be more prosperous than that one. So I'm trying to figure out if I want to move some resources around to take a position in this bear ETF, and or another one that we're also going to talk about in this video. Okay, so what we have here is, like I said, a monthly chart, and this moving average here is moving average. It's like a 7-day moving average on the monthly, and one key that gets my attention when something breaks the trend line, and this broke a trend line, it broke out, is when the moving average that was functioning as resistance, when it becomes support. When resistance, meaning that the price was below this line, when it breaks a trend line and the resistance becomes new support for the trend, that encourages me to stay with it. Stay with the trend. Now, the gentleman who bought the shares, I think he said he bought around $7 or something and sold around 11. So he was happy with his gain, but I was shocked that he sold so soon. But like I said, the literature that he read likely spooked him. Now, I'm gonna go out the way to show you where this thing was. Maybe actually, I don't have the data all the way back to 2009 to see where this thing started. Now, the highest point we have on here with the data we have, looking at this box on the right, that's like 28 million or something. Now, I don't know if this thing is going to get that high on the scale. I doubt it, okay? But this decline we're in, if I'm right, in my opinion, the low that you see on your charts for 2009 for the S&P 500 and the Dow, I believe we're going lower than that. Okay? I believe we're going to take that low out. Okay? So that's my big picture thesis that's based on the chart or the video that I did on January 13th. See, I'm still working within the context of that 100-year chart. Okay? So this downturn is contained within that chart, and there's a certain level it should fall, it should retrace, and that level is below the 2009 level. So if we have a fall that severe, and again, we have never had a decline that severe since the Great Depression era. We've never seen anything like this. So this might be that one in a million times. Who knows? It might come this high. If enough people jump on this, uh, it would have no way to go but up. And if it does happen, I want to be there. Now, let's say it just goes to this point. This would be like a natural support. And this is around 4 million. See, these numbers we're dealing with are so crazy. Okay, so let's zoom this in to something more. I don't even want to say the word realistic, but some smaller numbers that our brain can comprehend. Because something reaching the price level of 4 million, while it's at like $9 right now. I've never seen anything like this. And the guy who sold his shares, I think that he sold because he made so much money so fast. I think it scared him. And I think that's going to happen to a lot of people because we never been in this situation before. You know? Now, looking to where we are now and kind of going back, let's take this natural price support here. Even this price support is 1337.50, and we broke below that level 2 years ago this month. 2 years ago, and then we just kind of fell, and this moving average 7 day moving average was the resistance until we hit the low right here. If we just retraced up to that level, if this symbol TVIX obeyed and did what it says it's supposed to do, if it held in to do that just long enough to reach this resistance, you're talking about, let's see, that's over 10,000% gain. Now, everyone that's in the S&P 500 ETF, there's really nowhere else. There's a few places for them to go. And they're going to see this on the news about how much this thing is moving, and people are going to get in it. But here's my fear. Once it gets to be $1,000 or maybe at $100 at various price points, people are not going to afford to be able to buy it. So the conversation I'm having with myself is if I'm going to get in this, I need to get in it quickly, because I want to, and when I get in it, if I am getting in it pretty quickly, no way would I even think about selling this thing until I would have to get, I'm not saying I would even sell at this point, okay? But in my mind, I'm going to at least this point. And then I will take a look at it and see how many waves we have. I'll start trying to count waves. We should have enough data. Maybe there is no wave count. Maybe all of that is still a one wave, whether that's, let's say, an ABC pattern going up. Maybe we're still in the A wave. Maybe there's been no retraces along the way. What if we go straight up like a rocket to this level? And me being an Elliott wave practitioner, I have to consider that still in the A wave. And the pattern will be an ABC pattern. So I don't know how long that's going to go. But I do know the rule. And the rule is an uptrend makes a higher high and a higher low. Okay? And a downtrend is a lower low and a lower high. So you got a low here and you got a low there. That's lower. You got a high here and a lower high there. That's the way downtrends go. Lower low, lower high. This high is lower than that one. Lower low, lower high. Now this violated. This is your breakout of the trend line. It made a higher high and a higher low, a higher low and a higher high. That's uh, that's the deal. Hold on, let me show you on the. Now I went to a weekly chart. Okay, I wouldn't worry about this cross here. See, that's why I move around from quarterly, monthly to weekly. You get a chance to see how these stochastics look at different time frames. But this price broke out, and then once it broke out, of that trend line. Now that trend line is support. So when it breaks above this 1541 level, where it reached the first week of February, the market's really going to freak out then, and people are going to pile into this. So maybe the people missed an opportunity to buy it at the low of $4.66. They got another chance this past week to get it at $6.80. That was the low. Okay, once it passes here, I think it's going to be 25. It's going to get to $25 and $30 so fast. It's going to scare the heck out of everybody. And the guy who bought it at $7, he's really going he gonna learn quite a lesson. So what you what I will do if I buy this, like I said, I'm going to put my trend lines in, and I'm gonna look for the rule. And every time it does a move like this, where it has a little downtrend and springs out, that's an Elliott wave count. So that's 1, 2. Now we're in wave 3, and wave 3 is the most powerful wave. There's no way this thing is gonna stop until at least $40. I mean, I want to see what it does when it gets around $40, but that's pretty a given that it's going at least to that. And the $40 level will take us back to April. So at $40, we will have basically taken away a year of the losses, because we're going to be closer to April of 2018. So the thing is, I want people to pay attention to how fast things move. The saying in the industry is stocks take the escalator up and the elevator down. Prices fall a whole lot faster than they rise. And if you are in a bear market ETF, prices move even faster. This is a double leverage ETF. These things move like 5 and 6% a day, like it's nothing. That's just par for the course. So just beware of that. And so I'm gonna see how this stochastic. See, on the daily chart, the stochastic reached oversold, and it's showing that it's rising again. It's showing that we're rising again. But on the weekly, it will make you might think that it's gonna come all the way back down. No, it's not. No, it's not. So it's gonna turn and it's gonna come back up. And it can stay in that overbought state for quite a while. So all that to say is, hold on to your hat. Don't panic. Follow the rule of the higher high and the higher low. Okay. In that same vein, here we have Bank of America. Bank of America is one of the largest banks in America. Citibank and Bank of America, I believe they're the two largest. Okay. Uh, in 2006, that's what this high is. I'm calling it in my opinion, we completed a 5 count. This is 2009. This is where the S&P 500 started its rise. Bank of America had a retrace slightly more than 50%, but not quite 61.8%. That's 61.8. That's that golden ratio, golden mean number. That's the magic number. Okay, and it's right around in this area. I think we are going to be headed down. I believe we're going to be headed down this week, if not tomorrow. And so I'm considering buying this too. And I'm not going to mess around. If I'm going to buy this, I'm not even going to mess around on entry point. I'm just going to get in, okay? Because this thing has so far to fall. So this is the A, B, and C. Now this is zero, and I believe that I believe Bank of America could fall off the chart, could fall below zero. What happens then when it does that? They do I get this so confused, reverse stock split and stock split. They're gonna reprice it. Okay, so what they'll do is they'll take your shares and they will let's see, they'll figure out a formula. Let's say if they do a reverse split at 4 shares to 1. So for every 4 shares you own, or let's say 10 to 1, and for every 10 shares you own, they'll give you 1 share, then they'll multiply the price times 10. So you're going to still end up with the same value, but they're going to have to find a way to create more space on the chart. See, um, I've had this happen. When I was a rookie, I would believe in these figures on the scale, and I would say there's no way it can fall below zero. Crap, that's bull crap. They will do a reverse split and make this price, instead of it being $31, they'll make it say $300, and then the daggone thing will fall, and or they will make it say $100 or whatever, and then the thing would fall, and then the bottom price will end up around $31. Okay, so they'll play games with the price to create more space in the chart. So don't think that a stock can't fall farther because you see zero right there. Okay, that means nothing. That's how these ETFs got to have a high of 4 million and 28 million, because way back in 2009 it didn't say 4 million and 28 million. It said $100 or something like that. Now, when it kept falling, it got close to zero, and people thought that that represented a bottom, and they just did a reverse stock split, and they kept doing the reverse stock split to in order to fit it on the new chart. After they kept splitting the thing, the high from back in 2009 had to say something ridiculous like 41 million. Okay, now, all right, so that's Bank of America, and we got here on the stochastic, we got the uh, um, A, B, and I believe C. And this is a quarterly chart, and it has not flipped. The fast line, the black, hasn't flipped on this chart, but I believe we're going to come all the way down to oversold state on a quarterly chart, and that's going to end the run. Now, when you look at it on the monthly chart, you see it has flipped. Okay, the stochastic at that it has flipped there. So again, I'm primarily using the quarterly in terms of the stochastics. I'm waiting for us to be. I'm going to be bearish for as long or until we at least get to an oversold state on that quarterly chart. But first, in sequence, the daily chart will get oversold. Then the weekly chart will get oversold. Then this monthly chart we're looking at will get oversold. So I would watch those things as it happens. Okay. Um, and I'll of course I'll have trend lines up. I'll be counting my Elliott waves. I'll be looking for engulfing candlesticks. All of these things together. But again, I'm not a day trader. I'm trying to get all the money from the trend. Okay, it's a different philosophy. I'm not against day trading. That's just not my strategy. Now, day traders are into scalping. I would rather, when I find that if I catch a breakout, if I can hold my position for a couple of months after that, the price runs away so fast that I'm like so deep in the black that I no longer care about those little squiggles, those little up and down moves and retraces, because I'm like deeply, deeply in the black. Okay. I may have bought within 20% or something of the bottom. So I don't care about the fact that it had a 10% pullback when I'm already, maybe I've made four or five times my money. So the fact that it made a 10% pullback to me doesn't mean anything. I'm counting waves, and I'm trying to get out by the end of wave 3, which is because wave 4 has a serious pullback, and I don't want to give all the money back that I made in that. So my whole strategy is get in at the bottom after some technical indicators and trend line violations and engulfing candlesticks. After those things tell me that we've turned, and then hold it until the end of wave 3. Now, how long does that take? Honestly, I don't care. If it takes a year for me, I'll wait the year. If it takes 2, okay, because I'm in it to get all the money. And the more you trade, the more opportunities you have to make a mistake. And so, and this is a position I got to over time, over years. I realized to minimize my mistakes, I had to trade less. Okay. And I think as a beginner, I think that people should spend less time trading and more time charting. Get in on a trend and spend the rest of that time charting it along the way, testing these theories. If you want a paper trade, day trade in a demo account, go for it. You're gonna learn some stuff along the way, and then that paper trading will help you project when that wave 3 is over that I'm talking about. So you want to take a position. To the guy that took a position in TVIX, I was proud when he said he did that, and when he said he made money, I was even happier. But the next move to get to, this is just my opinion. I'm not his advisor. Is to get to the point where you're comfortable holding, that you don't sell for fear, that you make sure you have a technical reason why you sold. Okay, did it violate a trend line? Do you think that you're at the end of a wave count, a significant count, like the end of wave 3? Was there an engulfing candlestick? So, what was the technical reason for selling? That's the point of technical analysis is to eliminate fear, is to eliminate emotion, to make sure that you are even keel and you have some mathematical reason for your trade, either your buy or your sell. So you're on the right road, but be a little more determined to stay with the science, with the math. Let the math tell you when it's time to get out. Okay. Now, Bank of America is a bank, obviously. There is a financial ETF, bear ETF. The symbol is FAZ. And what I like about bar charts, they are more expensive than TradeView. Okay, but the way that the info, I would say significantly more expensive than TradeView. you would spend, I would say they're probably 3 times the cost of trading. They're pretty expensive, but I can make that money back. I could. I'm kind of. This is where I'm waffling. Do can I really justify paying 3 times the amount? I like how they put their information together, and if I was a subscriber, I could access even more information. I can get, and so they have a lot of screens here that I really like. But on this page here, what this is, they have a list of indicators. The short of it is they help you indicate when a trend is running out. Um, I do my wave counts. Y'all see how I do it with the stochastics and all of that and trend line violations. I also come here to kind of back up, put the exclamation point on my call. Okay, they have short term indicators, and that's like mostly 50 days and less. And the 50-day is 2.5 months. Okay, then you got your medium term indicators. Oh, okay, withdrawn. Okay, they just updated some information. Okay, and you got your long term indicators. Now, when a trend is at the end of a downtrend, all of this will be red. Everything will say sell. And their verdict over here will not say hold, it'll say strong sell. So when I'm trying to find stuff that's like near the end of the trend, I go in over here and I try to find the most hated stuff because that's when there's, as we say, blood in the streets, and I start making projections about when that trend's going to end. Now, at the end of the trend, you'll have a violation of like a 7-day moving average, a 10-day, a 20-day, and then medium, you'll get up to the 50-day and all of that stuff. But it's the short-term stuff I'm looking for first. But what I discovered is when you put your trend line in there, you get the trend line violation, you get the engulfing candlestick, then the engulfing candlestick, bullish engulfing candlestick will pull back and really it'll retest that trend line that you drew. By the time it does all of that, I come here to this trend spotter feature here, and I'll notice that this stuff will say buy. They'll all say buy. Okay, so over time, this will become buy. Not, and when I say over time, I think it's going to say it this week. Okay, we'll see. But I don't wait for to do what they say. I'm saying I would buy it now for me. I'm not saying what anybody else should do. I'm saying for me, I would buy it now, and just for entertainment, I'll see how long it takes them to change this here, because it's certain these indicators have to trip, and with regard to like we were looking at TVIX. TVIX says, let me show you. I believe there's say buy. It says buy. It says a 56. So 56%, that's not people. Those are indicators. 56% of their indicators, opinion rating is a 56% buy with a strengthening short-term outlook on maintaining the current direction, which is up. Okay. Longer term, the trend strength is average. Long-term indicators mostly agree with the trend. That's telling you all systems go. Okay, that the S&P is falling, that people are pouring money into this bear market fund, and probably in a month from now, this is going to say strong buy. And then the next level after that, it says very strong buy. Okay, so I want to be holding this as these more and more of these indicators clip off, and the more of these indicators clip off, the news media starts to talk this up, and then people start pouring their money on top of my money. Okay, so that's how that works. But let me go back to let me show you this chart real quick. can wrap this video up. Okay. Okay, for you volume watchers, maybe I can see what I need to see on. Yeah. All right. 2009. That's when the S&P and everything started rising. This FAZ, a high was 161,484. Okay. Then we got a natural support here at 26,353. For you volume watchers, what do you see? You see the biggest volume spike in the entire time since 2009. Okay, so again, banks were rising. So this bear market fund was taking a beating. I'm saying that it broke a trend line and that the bear market fund is now rising because banks have started to fall. These volume spikes, again, I don't really trade volume, but people keep asking me about it. These volume spikes, they're backing up my view. Big money has poured into this, and the volume spike is confirming that. Okay, we're looking at it on a monthly chart. We are we're low on this stochastic. We've come started to build momentum, and this stochastic has to come all the way up to these high marks that we've had here. And this is around, this one here is around 40. So I'm not even worrying about, hey, when should I get out? Let the stochastic, get up here somewhere in this area. Then by that time I'll have some data to look at, and I can start counting waves and stuff like that. But I'll be so deep in the black. I will have made so much money. Heck, maybe it'll be here at this 26,000. Okay, the current price is like $11. We don't know where that's going to go. Now, as far as a wave count, you see here, this is 2009. The stochastic information doesn't go back this far. We're at a price of 161,000. Let's just assume that the stochastic was in overbought stage. I mean, it's only common sense that the highest price on the page would have to be overbought. Okay, so let's do a count. We go from overbought to oversold. We go 1, 2, 3, 4, 5. Okay, then I had a trend line in here. We violated the volume spike. Is confirming that we've had a reversal. So we got our 5 count. We got our trend line violation. We got our volume spike. I mean, that's enough for me. That's enough for me. This is big money. Now again, this is banks. This is where the money goes when people want to make money off of Bank of America and other banks falling. This is where the money goes. Okay, so you can see if you had a trend line here how it popped. And what we have here, this is called an island reversal. You can look this up on Investopedia or just Google it. Island reversal. As you see with these candlesticks, the next day's candlestick always retraces back into the previous day's candlestick without making a higher high. But it goes back into the previous day's candlestick. Always, always, always. With an island reversal, the next day, the price opens at 9:30. It opens completely above the previous candlestick. There's no retrace on this day at least. Or in this case, in this week. These are weekly candlesticks. There's no retrace into the previous candlestick. They call that an island reversal. That means the buying pressure after this trend line broke, as these volume spike, when this volume spike happened, that means that the buying pressure was so great, it created an island. and everybody knows what that means. That's seriously into trading. Okay, and even within the island, the trend line broke, and looks like we're going higher. Now, when it crosses above here, this is high as 1339. We're going to be cooking with gasoline. All right, there will be no denial that the bear is back, or it has resumed, and we're in serious crisis. Everybody's going to know it. There'll be no denying. Okay, because as we take off, even this peak will have been taken out. Okay, so we will have done some serious structural damage, and no one will to the price and trend, and no one will be able to say that we're going higher. That craziness will stop. Okay. Again, I'm not worrying about this stochastic crossover right here, because if I come down to the daily, that's it. And what's likely to happen on this weekly chart, a lot of times it'll retrace maybe halfway and then start going north again. So it's a perspective thing. That's why I move around a lot, from daily to weekly to monthly to quarterly. You kind of get a sense of the scale of how the stochastic looks on different pages. So this is another one. And so right now the price is $11, and if we go up to that 26,000 here, oh my God, it's serious money. I don't know what it's going to do. I'm not saying that is what it's going to do. I do not know. Okay. Okay. Even if it just comes to this level, I guess this is a good first resistance. Some for support, broken support. Let me put it that way. $38. That's not bad. So that's a good near-term thing. Let's see what happens between $11 and $38. Okay. So we talking about, tripling your money or something, getting in that neighborhood of tripling your money. We'll see. But I think we go significantly higher. And I just wanted to point your attention to that, because this is where the real money is made right now. With all the complaining on TV and the sky's falling, don't ever forget that someone is making money while a lot of people are losing money. And this is how they're doing it. They're buying these bear market ETFs. That's how the big money is being made. This is like the risky cryptocurrency trade in the stock market. Okay, so I just wanted to make this video so you would know what's going on. Don't buy the hype that everybody's losing money. Everybody's not losing money. Your money that you're losing is going to somebody's pockets, and it's going to the pockets of the people who are trading these bear market ETFs. The 1%, they hate these instruments. They call them weapons of financial disaster, financial destruction, okay? Because it's their money that's being destroyed quickly with these. If you like the video, press like, make a comment, subscribe, hit the alarm, share it with someone you know that needs to get their trading game going, okay? That's all I got. Later.